Hi folks, welcome back to Meaningful Money. Okay, we're going to move on to talk about taking money out of your pension fund now. I introduced that last time. Specifically this time, and for the next video I think as well, we're going to be talking about annuities. Now, an annuity is simply a way of taking money out of this pension fund that you've amassed. Specifically, I'm not talking about company pensions here, but certainly not final salary pensions. But when you have any of the other kind of pensions where all you've done really up to now is built up a nice pot of money for your retirement, this is how we convert that into an income. And that's really all an annuity is. It's a sort of technical term, an industry word, but an annuity is a contract, a product, a financial product if you like, whereby you hand over your fund, your amassed pension fund, and in return the insurance company offering the annuity gives you an income for life. Sounds straightforward enough, but as ever it isn't. There's some things we need to bear in mind as we do that. But the biggest thing I think probably to take into account at this early stage is that what I've just described, the transaction where you hand over your pot and you get an income for life, it really is that serious. You hand over your pot, it's gone. So all the saving you've done over the years is over. You've handed over your pot and instead now you get an income for life. There's a couple of things we need to bear in mind, and we'll talk about that in a minute, because that's a big deal. If you've got any kind of pension pot at all, it's not a decision to be taken lightly to hand that over once and for all. Now, as it stands at the moment, actually, or until a couple of months ago, you had to buy an annuity at age 75 at the latest. You can do it any age from 55 currently, but until recently you had to buy an annuity from age 75. In the June budget, the Chancellor put that back to 77, pending consultation, because there is hope and it looks like an intention to remove the necessity to buy an annuity at any point. So it could be that you keep your fund for the rest of your life. There's reasons why you might want to do that, which I'll come to in due course. But as it stands at the moment, you have to buy an annuity by age 77, pending the outcome of this consultation. Now, one really important thing to say about an annuity is it's a completely separate contract from the pension pot that you've saved in over the years. So if you have amassed money with, let's say, Legal & General, an insurance company, you don't have to buy your annuity with Legal & General. The whole world is your oyster, and every annuity company is going to be vying for your business. And that sort of right, if you like, to get your annuity from any company is called the open market option, and it's one of the most underused facilities, because so many people just think, well, I've saved with Legal & General, I'll take my annuity with Legal & General, and that may or may not be a good thing. The open market option means you can get your annuity from whoever is going to give you the most money in income terms for the benefits that you want. I'll give you an example of that. We had a client at my company, Jackson's. My colleague Roger was dealing with it, and he'd been saving, I can't remember the name of the company, but he'd been saving all his life with one company and had amassed a reasonable sized pension pot, 6 figures. But he had been diagnosed quite recently with a form of cancer. Now, it was a treatable cancer, and I'm pleased to say that he's going on very well. But when he got to age 65, his pension company that he'd been saving with offered him some terms, a sort of an amount of income that he could have for the rest of his life in return for his pension fund. Now, fortunately, he had the sense to go and see my colleague Roger, who was able to ask him some questions about his health, and because he'd been poorly, my colleague was able to double the income that he got from his pension just by shopping around. Double, I mean, that's just an incredible increase. So the open market option, this facility you have to take your eventual annuity from any company in the market, not just the company you've saved up with, is really valuable. So it's important that you look around when it comes to choosing an annuity. So some key points when it comes to annuities, okay, and we'll get into some down and dirty detail next time. First thing to mention is that your pot, however big it is, you can have a quarter of that pot as a tax-free lump sum, a nice bung of cash removed from your pension pot and put nice and squarely in your bank account for you to spend as you wish. There's no tax on that. Technically speaking, it's called a pension commencement lump sum, but everybody still calls it tax-free cash. Well, hopefully that facility will continue, but a quarter of your total sum can be taken as a tax-free cash lump sum. it's usually the right thing to do, but it depends on your circumstances. Second thing to mention is that annuities are insured. That means they're offered by insurance companies, and because of that there's certain protections under the compensation scheme if that insurance company goes bust and can't honour its liability to you to pay you the income for the rest of your life. So insured is good for the most part. It's guaranteed. Once you have chosen your options and you've agreed with the annuity company the amount that they're going to pay you, then it's guaranteed. Once it's done, it's set in stone. But again, I'll say it's an irreversible one-off transaction, and so you've got to make it right. You've got to make the decisions right, and that's usually a good idea to get competent independent advice at this time. I know I've got a vested interest in saying that, but it's just too big a decision to get wrong. So you need to know what all your options are, and that of course is part of the purpose of these videos. But if it's a one-off irreversible transaction, let's say I've got a £100,000 fund and I want to hand that over to a company and get an income for life, and let's say that income for life is about £6,000 a year, okay, 6% return. Well, what happens if I die after the first year? I've given away 100 grand and I've had 6,000 in return in income because I've only lived a year. That's a pretty bad deal, right? Well, that is the biggest risk of annuities. It's called mortality risk. This is not about investment risk, the fact that shares or investments can go up and down. This is a mortality risk. It's something you can do absolutely nothing about because nobody knows when they're going to die. And with annuities there is an element of what we call cross-subsidy, because the person that lives for 35, 40 years after they take their annuity, and lives to like 110 or something, is subsidised by the person that dies after a year, because they haven't had all their benefit, and so the person who lives for too long, according to the insurance companies, gets the benefit of the person who dies early. So it's a big risk, annuities. You have to know when you're going to die, so if you've got that sorted, then go for it. But it's an important factor when considering whether we go for an annuity or not. Final thing to say is that everything I've said so far, and what I'm going to talk about in the next video, is about what we call conventional annuities or lifetime annuities. They're the sort of types of annuity that have been around forever and ever, and they're dead straightforward. Hand your money over, get an agreed income for life, nothing changes. There are alternatives though, things called variable annuities or fixed term annuities, and I'll deal with those the time after next. So that's your basis of annuities. It's an important decision, but remember, if there's one thing you take from this video, it's that you don't have to take your annuity from the company with which you've been saving into your pension all these years. And that facility is called the open market option. So make the most of it. There's a fly on my nose or something. Make the most of it because it's an incredibly valuable facility. Okay, so next we're going to go into more detail about annuities, and specifically the factors which determine what amount of income you're going to get out of your amassed pot. So thanks for watching, and goodbye from, I never told you where I was, a little field just above Penberth.